Hi everybody, welcome to Deep Well Talks. We all have expectations in life, but if the actual life does not happen as per our expectations, we become unhappy, and if the actual life happens as per our expectations, we normally become happy. Similarly, when it comes to investing, if the actual return deviates from our expected returns, we become unhappy and we perceive it as an investment risk. And if the actual return does not deviate from our expected returns, we become happy and we perceive it as a safe investment. Which means if we are investing into the most guaranteed organization with least credit risk which is available in our country, and if they offer a 7% rate, we normally expect this 7% rate and we get this 7% rate, which means there is no volatility for our returns virtually. So we feel this as a safe investment. And safety of investments is the prime concern for many investors. Now let's analyze what is the level of safety we have for our investments. Let's see some safe investment which we feel as safe. The first one is, in India, fixed deposit in scheduled banks are considered to be one of the safest investment for many investors. They prefer fixed deposit than bonds or debentures or shares of the same organization, even though they are compensated for their liquidity and market risk in terms of risk premium. The second one is government bonds. If we have invested into government bonds, we feel it as safe since it is the most guaranteed investment, since government has got sovereign powers like taxation, borrow funds from other countries, and even print currency in case of need by following its procedure. So government bonds can be considered to be investment with least credit or default risk in the respective nations. But the story does not end there. Let's have a deep analysis and find the reality or real returns of our investments. Fixed deposit has an additional safety up to 5 lakhs per account holder in a bank, since the scheduled banks have to mandatorily insure all the account holders to DICGC, which is Deposit Insurance Credit Guarantee Corporation. But above 5 lakhs, all forms of investment in a scheduled bank pose the same credit risk or default risk, except that FD or bonds have preference over shares while settling in case of failure of the organization, since shares represent ownership of the organization. The expectation may be FD is generally safe, but the reality is that they have an additional safety only up to 5 lakhs per account holder in a bank. Now let's take the case of government bonds. Let's assume that we have invested into a 10-year plain vanilla bond with rate as 7%. After 2 years, if the market interest rate has increased and the same issuer is offering a higher rate, say 8%. Here we are at a loss of 1% since we lost the opportunity of earning 1% more because we'll be getting only 7% in all these 10 years. This is called as interest rate risk. But during the same period, that is after 2 years, the market interest rate has decreased by 1%. And if we want to reinvest our interest payments, we are losing by 1% for our reinvestment opportunity. This is called as reinvestment risk. And if during the same period, inflation has increased by 1%, then our purchasing power or real return will be decreased by 1%. It is called as inflation risk or purchasing power risk. If our investments are traded in the market and there is a price determination based on supply and demand, then we can see a price volatility even for a government bond as per the future market expectation, which is called as market risk. If we require our investments to be sold in between, and if there is no buyer for our investments, it cannot be converted into cash. It is called as liquidity risk. If there is a regulatory change happening in our country, our investments may get affected, which is called as regulatory risk. And as part of reducing risk due to the above reasons, we are investing into a different country, then return will be affected as per the magnitude of changes happening in the exchange rate between these two countries, which is called as currency risk. If there is a political or economic uncertainty in our invested country, then our investments will get affected, which is called as country risk. If there is a war or tension happening in our invested country, then also our investment will get affected, which is called as geopolitical risk. Here we can see that all these investments pose some amount of risk, because in all these cases, real or actual return has deviated from expected returns. So these deviations from our expectations may be due to reducible or controllable or diversifiable risk factors either by the organization or the investor, which is called as unsystematic risk factors, which I have talked about in my previous video, or it may be due to non-reducible or non-controllable or non-diversifiable risk factors called systematic risk factors, which affect all organization or the entire system because of the changes happening in the macroeconomic variables and global changes. For example, interest rate risk is non-reducible because no one can exactly predict over the changing interest rate cycles of the country. Reinvestment risk is non-reducible because no one can exactly predict over the changing interest rate cycles of the country and thereby the reinvestment rate. Inflation risk is non-reducible because no one can exactly predict the future inflation levels. Market risk is non-reducible because no one can exactly predict the future market expectations. Liquidity risk is non-reducible because no one can exactly predict the liquidity position of any investments. Regulatory risk is non-reducible because no one can exactly predict the regulatory changes of any country. Exchange rate risk is non-reducible because no one can exactly predict the future exchange rates with any country. Country risk is non-reducible because no one can exactly predict over the political and economic uncertainties of any country. Geopolitical risk is non-reducible because no one can exactly predict wars or tensions between the countries. So, systematic risk factors cannot be eliminated since everything is changing in this world. And there is only one thing which is not changing, and its name is change. And because of that, there is no 100% safe investment in real returns. Since systematic risk factors cannot be eliminated, let's see how we can manage our investments in the next video. Thank you.